In this video, we're going to talk about the 12 best dividend stocks for retirement. So before starting, please like this video and subscribe to this channel for future updates. A well-balanced retirement portfolio can include dividend equities, and an increasing number of investors are doing just that. We've selected dividend stocks that can provide quarterly income that reduces losses and amplifies gains, reducing the impact of market downturns or igniting rallies. It makes a ton of sense to build a retirement portfolio that includes a sizable portion of companies with alluring dividends, according to David Giroux, a portfolio manager at T. Rowe Price. Your dividends should increase if the typical market business can increase its earnings by 7% to 8% annually. Here are our 12 best dividend stocks for retirement. Number 12. Alexandria Real Estate Equities, stock ticker, ARE. For a retirement portfolio, real estate investment trusts, also known as REIT, are a good option because they must distribute at least 90% of their taxable income to shareholders. Alexandria Real Estate Equities, which returns 2.4%, is one to take into account. The company has a number of office buildings that serve businesses in a variety of industries, including biotechnology, agricultural technology, and pharmaceuticals, all of which are wise investments for long-term dividend investors. Number 11. Chevron, stock ticker, CVX. Chevron was able to steadily raise its distribution over that time, in contrast to rival ExxonMobil, whose dividend looked like it would be reduced in recent years due to a sluggish global energy market. In contrast, ExxonMobil announced its first dividend raise in 2.5 years when it did so in October. At the company's investor day earlier this month, CEO Michael Wirth stated that we anticipate increasing cash flow to support rising dividends. Without a question, the increase in oil prices has been a positive factor for Chevron's capital gains, including its dividend. Number 10. Coca-Cola, stock ticker, KO. The corporation has only modestly increased its dividend in recent years, at a low single-digit rate. Coca-Cola, on the other hand, has been the model of dividend stability, raising its distribution for 60 years running. Additionally, the corporation has been authorized to buy back $10 billion worth of shares. Regarding the company's capital return possibilities, Stephanie Link of Hightower Advisors comments, "It's a wonderful blend." Free cash flow for the beverage manufacturer reached $11.3 billion in 2017, up from $8.7 billion in 2020. All of that is encouraging for dividend increases. Number 9. Colgate-Palmolive, stock ticker, CL. The consumer goods firm is ready to increase its yearly dividend for the 60th consecutive year. It is recognized for brands including its eponymous toothpaste and Speed Stick deodorant, among many others. The company's board announced earlier this month a quarterly payout of 47 cents per share, up 2 cents or around 4%, significantly below the rapidly increasing inflation rate. Nevertheless, the $2.8 billion in free cash flow generated last year was sufficient to offset the $1.7 billion in dividends paid. Although the level of inflation isn't anticipated to last for very long, Colgate-Palmolive's prospects for continuing to pay out and increase its dividend each year seem like a strong long-term investment. Number 8. Johnson & Johnson, stock ticker, J&J. Johnson & Johnson is a holding company, which engages in the research and development, manufacture and sale of products in the healthcare field. It operates through the following segments: consumer health, pharmaceutical, and medical devices. Few businesses can rival Johnson & Johnson's length and stability of dividend, making it a solid investment for dividend retirement. In April 2020, as many corporations were suspending or reducing their dividends due to the pandemic, the healthcare conglomerate implemented a quarterly dividend rise of 6% to $1.01 per share. The quarterly distribution was increased once more by the firm in April 2021, to $1.06 per share, for the 59th year running. CEO Joaquin Dueto remarked, "We're going to have the flexibility and muscle to continue to enhance our dividend," in a January speech to investors. Number 7. JPMorgan Chase, stock ticker, JMP. Now that it has moved past pandemic-related restrictions on dividend growth imposed by the Federal Reserve, the country's largest bank by assets has its payout on a good trajectory. In the fall, the company boosted its quarterly dividend to $1 a share, up 11%. The bank's longtime CEO, Jamie Dimon, will retire someday, but I'm confident there will be a great successor, says Dave King of Columbia Threadneedle Investments, adding that the stock has a solid yield and a great record of growing dividends. The shares, down about 12% this year, are trading around 12 times the $11.27 a share analysts polled by Facts said expected to earn this year. Number 6. NextEra Energy, stock ticker, NEE. NextEra Energy Incorporated is an American energy company with revenues of over $18 billion in 2020, and about 14,900 employees throughout the US and Canada. It is the largest electric utility holding company by market capitalization. NextEra Energy, however, offers two plays in one. Utilities are popular among equity income investors. NextEra is also a major player in alternative energy, notably wind and solar. These alternatives diversify its revenue mix and help solidify the dividend. In February, the company's board declared a quarterly dividend of 42.5 cents a share, an increase of about 10%. It's the latest in a series of double-digit dividend increases that make life easier for retirees. Number 5. Procter Gamble, stock ticker, PG. The consumer products behemoth, whose signature brands include Crest toothpaste and Tide laundry detergent, proved its mettle early in the pandemic, raising its quarterly payout by 6% to 79.07 cents a share in April 2020. The company's adjusted free cash flow totaled $15.8 billion in its most recent fiscal year, which ended in June, up from $14.9 billion in fiscal 2020. In January, the company said it expects earnings this fiscal year, which ends in June, to increase by 6% to 9%, likely paving the way for a bigger dividend. Number 4. Prologis, stock ticker, PLD. Prologis Incorporated is a real estate investment trust also known as a REIT. The company invests in warehouses. Prologis has yielded about 2%, and offers investors a play on global e-commerce, thanks to the company's portfolio of warehouses. It's a business that has staying power for those thinking about it as a long-term holding, in particular its dividend. The yield isn't as high as those of many other REITs, but it has increased its dividend at a good clip. The company's board in February declared a quarterly distribution of 79 cents a share, up 25% from 63 cents. For now, Prologis is in growth mode, plowing a lot of its capital back into the company. Besides offering a reliable yield, this stock has a 3-year annual price gain of about 28%. Number 3. Target, stock ticker, TGT. The retailer is a serial dividend booster, having done so for 50 straight years, most recently in June. The company will continue to focus on growing the annual dividend, CFO Michael Fiddelk told analysts during the fiscal fourth quarter earnings call on March 1st. He added that Target plans to recommend later this year that its board approve a per share dividend increase in the 20% to 30% range as we continue to move toward a 40% payout ratio over time. During the previous fiscal year, Target declared dividends of $3.38 a share on earnings of $13.56. That's a payout ratio of around 24%, leaving room for dividend hikes. Number 2. Union Pacific, stock ticker, UNP. A favorite stock of the exceptional investor Warren Buffett. This freight railroad boosted its quarterly disbursement late last year to $1.18 a share, an increase of about 10%. It declared a similar increase in May. At 1.8%, the stock's yield isn't all that exciting. However, Stephanie Link of Hightower Advisors regards this as a dividend growth play more than a straight play on yield, an important component of a retirement portfolio. The company's dividend payout is smaller than its share repurchases, $2.8 billion versus $7 billion in 2021. But with strong free cash flow, they remain consistent on shareholder returns, Link says. Number 1. Verizon Communications, stock ticker, VZ. This stock offers a nice yield of around 5%, but the trade-off is that the dividend has been growing slowly. It was most recently raised in September, by 2% to 64 cents a share. Jenny Harrington of Gilman Hill Asset Management says heavy investments in 5G could help earnings growth, which she expects to be modest in the near term. Analysts polled by FactSet are looking for the telecom's earnings to come in at $5.46 a share this year, up a bit from $5.39 in 2021. Which of these 12 long-term stocks would you like to add to your retirement investment portfolio? Let us know in the comments below. Thank you for watching, and don't forget to subscribe to our channel for new weekly investing videos.